Artificial intelligence is making exponential strides in many areas, one of which is investment management. I have asked Vincent Anthonyrajah, CEO, and Musa Malwandla, Co-CIO of Differential Capital, to discuss the potential of AI outperforming traditional investment strategies in the long run. Here is what they had to say.
That's what we wanted. Differential was founded about 5 years ago, and we started managing money late 2019, and the business went straight into the COVID crisis. And that was pure hell. I mean, markets were crashing. It was difficult to raise capital. But it was a blessing for the business because what I think really sets us apart is that we were born in crisis. It was a very stressful time to manage money. It was very stressful for the team. And in many ways, that was also really important in how we built our culture, because we learned how to treat each other. We learned how to handle managing capital under huge amounts of pressure. And that's taught us how to be incredibly grateful for the support that our clients have given us. You know, every day we wake up in the morning looking for returns for those clients. But it also taught us how to look for opportunities when things look really bad. I think that was important for how Differential was formed and how our culture came about. In terms of why we founded the company and what we think is our edge, there are huge amounts of data being generated every day, and I think humanity is only just getting started. Now, we think that investment managers that focus on this data, and yes, it's short term, and yes, many people treat it as noise, but we think there are elements of that data that are possibly really important when you're making investment decisions. And we thought that using AI tools and alternative data would be really powerful ways in which we could distill that data, look at that information, and see if there's any really important investment signals there. And that, we think, combined with a very strong investment team, really sets us apart and makes us very different to our competitors. You know, the vast amount of asset managers in South Africa focus on the long term and treat, you know, a lot of this information as noise. We think there's opportunity.
Yes, so I think there are three main ways in which AI enhances traditional asset management. The first one is in terms of speed. In financial markets, information is always arriving. And in order to be on top of it, what you would normally need to do is to have massive teams of people, which, you know, quickly becomes infeasible. So what AI allows you to do is to have that same amount of coverage with a far smaller team. The other aspect is in terms of accuracy. So this is quite important in that in financial markets, the amount of data that's out there is simply vast. It's so much that a normal human being cannot account for all of it. What AI does, and even traditional models, is that they have a way of distilling this information and figuring out which types of information are most relevant when trying to solve a particular problem. Now, if you take these two things, accuracy and speed, and you apply them to a traditional investment team, what it means is that now you can generate ideas quicker, and the ideas tend to be higher quality because the models enhance the accuracy. And it means, for example, where you would have normally needed a massive team to cover, for example, the global universe of stocks, you can now do that with a much smaller complement of people. Some practical examples in our case of the successes of AI in the investment process is an investment we made in the second quarter of the year. So what this investment was in the first quarter of the year, in March, what happened is that gold miners started to outrun the gold commodity itself. And this was because of a number of factors, including index reweightings. Now, what our model started to flag as soon as this started to happen is an opportunity where you could structure a trade where in a hedge fund, for example, you could go long short one instrument and short the other. And there was a way of structuring that in the long only. Now, what it meant in our team is that as soon as it was flagged, our team quickly looked at the idea, investigated it, to make sure that it's real. It's not just, a misprediction by the model. Now, this one idea, which we implemented both in our long-only fund and in our hedge fund, generated 1% in alpha over a quarter. And that's, that's a good example of AI at work.
So we think that AI will complement human beings in making investment decisions purely because of the ability to crunch huge amounts of data all the time. And having a machine do that all the time, 24 hours a day, we think is a big competitive advantage. And being able to build the tools that run those AI models. How it complements an existing team is that we're still investing in companies that have management teams. These management teams have huge amounts of employees sometimes. There's a culture that needs to be analyzed. There's a balance sheet. There's a lot of traditional investment metrics that we think human beings are inherently better placed than machines, and possibly will always be better than machines. But what machines can do is crunch all of this data, all of this information, and let the human beings understand where to focus. We think that synergy itself is a competitive advantage.
So the biggest point to maybe account for when you think about AI-driven strategies is that any model relies on data, and data tends to be backward-looking. Now, what it means is that if there's new sets of information that the model has never seen, in other words, if there are structural breaks in the market, a model will mislead you, right? The other important thing to consider here is that the applicability of a model will always be based on the kinds of information that are going into the model. For example, if you build a model based in econometric data, you cannot expect that kind of model to make predictions around geopolitics, because that's not the kind of data it has. So what that means for our team, and this is how we've structured our team, is that it means that in periods where there are massive dislocations in markets, it's very important to have in your team highly experienced professionals that work alongside the machines, so that in cases where we see structural breaks in the market, we have a team of people who have seen it before, have observed massive numbers of market cycles and understand how things might unfold. So we think that the future requires both types of skill set, the machine-driven kind of skill set, and then the traditional investment management.